training would always probably say, unless you're willing to explore a very your own self, you can't explore it within another person. And I learned this the hard way. It was on my forensics rotation through psychiatry training. So I would.
Hey, Neil.
Hey, Peter.
Thank you for doing this. We appreciate it.
Always happy to talk about our business.
Good. Make sure that this gets transcribed and so on for people that want that. And Zoom is recording it, just to let you know.
Yep.
Hmm.
I copied what was in the calendar and sent it to him right now.
Okay, that should work. It should work. Huh. If it still doesn't work, come back and nudge me again. Okay, that's coming out good. Just to let you all know, I'm arranging windows and trying to have everything at my fingertips. And this will be recorded, and we will also have a transcript. Okay, good. And these. One minute as people are straggling in here. Okay, quite a good turnout. Oh, there he is. Good, good, good. Okay, we've got 11 participants and one or two that couldn't make it today, but they will be able to tune in to the recording. So welcome to an update on your Prana investments on October 23rd, 2024. If you hear any barking during the call, I don't know anything about it, except that I have a dog here. But she's promised to be quiet so that we can talk. So we're joined by Neil McKinnon, who's heading up Prana these days, and so communicative and so appreciated how you guys are always willing to be transparent and to fill us in on what's going on. Because in my research, there's different cross currents occurring in New York City real estate right now. And Neil, would you like me to run the slideshow?
Sure. Thank you, everybody, for joining us. We appreciate obviously your investment, and we're trying to be good stewards of it in a difficult market. Peter's comment about the dog reminds me that I wish I had my therapy dog here with me in the office, but he can't be with me all the time, so there'll be no barking at my end anyway. So Peter, I don't know whether you got I just sent you literally 10 minutes before the call, updated version. Did you get that?
I sure did, and I've got it up and ready to go.
Okay, well, why don't we start it then? And, just in the past, you guys have been good about asking questions. Feel free to interject with any questions. Things that I don't cover. We have reasonably extensive correspondence, but I'm actually going to get into a little more detail on some of the funds than maybe is in our correspondence. But if there's other topics that you want me to cover, by all means, let me know. And Peter, I don't know whether there's a question function there that you filter the questions, or, I guess people can speak for themselves.
Yeah, I don't have a filtering function activated, but we do have the chat capability activated, and I've got my eye on the chat window, so you can raise your hands, I believe. That's kind of something that I'm getting used to, but you can certainly put things in the chat, or you can just unmute yourself and ask a question. It's a pretty small group, pretty friendly group. And I think by starting with the slides, we'll have a good basis for a discussion going then, because we kind of need to get into the mindset. And I'm anxious to see what your latest thinking is in this changing world of ours. So I'm going to share my screen and the slides, and we can get going. Oops, one more second. I got to do one more thing. Keep changing the way the buttons work here, so I won't need that, but here we go. Okie dokie. So just give me the signal when you want me to move on.
Let's go to the next slide. Yeah, this is just what we're going to cover today. I'm going to talk very briefly about the capital markets. And then I think the most important initiatives that we've had really since the beginning of the pandemic, the signature loan opportunity and Article 11 in New York City. Then I'm going to go through by fund, how it impacts each fund. I'm not sure, based on the number of people we have on the call, we probably have somebody in almost every single one of these funds. Prana Realty is the largest contingency of Peter's clients, so we'll spend some time on that, and then we'll summarize and have a Q&A. But if there's something along the way that you want to get into, let's do it. Next slide, Peter. The capital markets, unfortunately, have not changed in our markets, even with the 50 basis point cut by the Fed. The long bond, as you know, is over the last couple of weeks started going back up. And our big issue in our markets is the lack of lenders. So as we've talked about, the regional banks that served as the backbone of lenders in our market have gone by the wayside, and no one's really replaced them. Although in Los Angeles, we are seeing the banks come back in a modest way, but New York is where it's really a black hole. So the market's making the transition to agency financing, Fannie and Freddie. It's in some ways it's more attractive financing economically, but it ties you up for a much longer period of time, and it's a lot of hoops to go through to get that financing. So the market's trying to make that transition, but it's tough. So the lending market is not in good shape in our markets. And then the combination of the lending market being in disarray, the drop in values has meant that there's just not been a lot of transactions happening. Any transactions that are happening are primarily fire sales. And just to give you an idea, in the Bronx and Upper Manhattan in New York, where we do a lot of our work, and then also in the markets and submarkets in LA, transaction volumes are 10 or 20% of the peak levels. So there's really not much getting done in these markets. Anything that's getting done is usually being sold for $1 over the mortgage. So they're true fire sales. So we just haven't seen a recovery in 2024. If the economy stays in place and maybe we see some further rate cuts from the Fed, that could change over the next 6 months, but we're not certain of how that's going to play out. We thought by now there would have been some improvement in the lending markets. Next slide. So the first of our big opportunities, this is probably the one that's closest to coming together. As you recall, Signature Bank failed in March of 2023. We had over $220 million of loans originated by them. In February of this year, the loan pool that our loans were in was purchased by Related, which is a big real estate investment development company, and two New York-based nonprofits. They're the managers of the pool. The FDIC has retained a 95% interest in it. And their goal is twofold. One is to recover the dollars that are out there that Signature originally lent and FDIC took over, but also to stabilize and protect affordable housing, and specifically the rent stabilized housing. So those two objectives can work together, but they also can be at odds with one another. Right now, they're in the phase of wanting to work with good operators, of which we're one, and stabilize these buildings. So there's an opportunity here to work with the FDIC and Related to recast these loans. Prana Realty has the biggest opportunity. Over 70% of their loans are Signature Bank originated. Prana Perennial Fund 5 and Prana Perennial Fund 3 are the next largest in our portfolio. So you can see there's a big dollar amount that we can work with Related to recast. So what they're planning to do is extend the loans for 8 years, lower the interest rate to either set the existing rate as the going forward rate, or 5%, whichever is lower. And on this portfolio, that'll push down our interest rate from 4.1% to about 3.9%. So we're well below the 5%. And then they'll do up to actually 24% discount on the principal balance. And of the mortgage, it varies by property. It depends on how much the property can sustain at the new interest rate that they've set. But we're seeing discounts ranging from 0. Some buildings, are cash flowing enough that they're not in line for discounts. Others are getting the maximum 23, 24%. So it is a calculation done by each building, which obviously rolls into each partnership. And in return for these discounts, the discounts are going to be totally complete in 3 years' time. We've got to run the buildings pretty much as we've done throughout our whole time, meaning keeping the violations on the buildings low, keeping the buildings functioning operating properly, providing the necessary capital expenditures. So that's the trade is a big discount on a lot of the loan principal, setting a low interest rate on the mortgage, and in return we got to operate the properties as we do now, essentially. So this is, like I said, we're on our second term sheet with Related, and we hope in the next few weeks here to finalize this deal across our portfolio. That's the plan anyway. So that's opportunity number one.
Well, I have a question there.
Sure.
I have not run across mortgage principal discounts before, but from what you're saying, it sounds like this means that they would just forgive part of the loan and issue a new loan based on a fractional amount.
That's right.
Wow. I'd be interested to know how much that might boost the value of the investments, and of course the cash flow.
We have that in each of the individual funds that we'll come to.
Fantastic.
We have that by fund, and again, these are all projections. The usual caveats that in the case of the FDIC, we're dealing with a governmental entity. In the case of our Article 11, which we'll come to in a second, we're dealing with another governmental entity. And just to give you a flavor, last summer with the FDIC, before they sold the loan pool to Related, we actually had deals on the table very similar to this for our 15 largest loans with the FDIC. And I flew out to New York for a meeting. We were going to basically finalize the terms, and they came in the meeting and said, we got word from Washington that we're not doing any deals. We're putting everything in the loan pool. So we've been down this path before, and I don't want to, say that this is a certain deal and these terms are going to be exactly as I'm outlining here, because as you might expect, there's a lot of political elements in play.
Indeed. And
can I raise a question?
Sure.
So, but the valuation of the properties has declined. So having the mortgage principal discount, let's just say 15%, in how does that relate to the value of the property having declined?
Well,
you know what I mean?
I think, we're looking at it from the standpoint of you have the value of the property less the mortgage. So this is something where, yes, the value of the property has declined, but we're going to get a discount on the mortgage. So that should improve the remaining equity in the fund.
Right. So big question is, how much did it decline versus the 15 to 23% that the mortgage discount would be? Am I right?
Yeah, that's part of it, but
Okay.
we should end up with also a better NOI on these things, which in turn would improve the value ultimately too. So, we'll have to see how this plays out, but this is one part of it, and we're taking advantage of this because, if we get a 15% reduction in the principal balance of the loan, that'll go right to the value of the portfolio.
Mm-hmm. Okay, thanks.
okay.
Next slide, Peter. So this is Article 11 and Section 610, and we went into some detail in our correspondence, and I don't want to retrace that for everybody that's read the correspondence. But in summary, Article 11 is something in the New York City Housing Code. It's been around for multiple decades. We actually have bought some buildings, not in any of these partnerships, but in other partnerships, that have Article 11 regulatory agreements in them. And the trade here is you as the building owner do a substantial rehab of your properties, and in return, your real estate taxes are set at a greatly reduced rate, usually 5% of your residential revenues. We haven't wanted to do that in the past because all you got was the expense reduction. Didn't really help you on the rental side, and the rental side is where the greatest stress in our portfolios is. But in 2023, they added something to Article 11 called Section 610, which basically tries to address the income side of the equation. And so there, if you have Section 8 tenants or are willing to put in, when you get a unit vacant, a Section 8 tenant, or someone coming out of one of the many New York City housing programs, those rents can be set at essentially the full Section 8 rent for our markets. And that rent is 30, 40, 50% above where the stabilized rents are. So we think since the traditional rent stabilized business that we've been in has been affected materially by overregulation, we're gonna basically hug the bear, so to speak, here and try to get as many properties, hopefully all of our New York properties, into these regulatory agreements, Article 11, Section 610. So it's a 40-year agreement, and it's very specific as to who you can rent to. The AMI levels, which are basically the income levels, probably won't affect us. We were leasing to working class people previously, so it doesn't really affect us. It does affect us when they set that, you know, we have to rent 20% of our building to Section 8 tenants, for example. That's maybe a little bit more of a management challenge, but again, the trade-off is you get much higher rents. So we think this is something that we want to undertake as quickly and as aggressively as possible. That remains to be seen how quickly we can do that, given that we're dealing with a governmental entity. But the end result should be that our real estate taxes are cut by 2/3, and our overall rents should be about 20% above where they are currently. Besides having being very specific provisions as to who we can rent to, there's going to be conditions about building maintenance and capital expenditures on the property that we'll have to undertake. So those are part of the negotiation with the city, specifically the capital expenditures. But again, so we've been accepted when we bought buildings with these regulatory agreements by HPD. They know we're a good manager, so it's going to be a negotiation on what work needs to be done, when, and at what cost. So overall, as I said, this is something we want to move on as quickly as we can, but we think it may take 12 to 18 months to get all our buildings into this program.
Wow. So interesting to me as an investor that these are not market-driven changes. In this case, these different forms of relief come from political decisions and regulations and the changing banking environment, which is more unpredictable than just regular markets, but sounds promising.
Yeah, I see there was a question in the chat box about the rent stabilized rents, and that's an excellent question. The good news in both New York and LA is that the base rent increases have been reinstated. Believe it or not, LA just reinstated them after 4 years of rent freezes in February of this year. New York did it about a year prior. LA is a little bit higher. Base rents can be increased between 4% and 6%, depending on who's paying the utilities. The New York base rent increase is about 3%, which is better than zero. But given that we had 3 years of rent freezes, several years of operating cost inflation, specifically on insurance and to some extent on energy, this is a catch-up game. And one of the reasons that we've been squeezed as far as distributions to investors is that expenses have gone up. The rent freezes were in place, and then now we're getting modest rent increases, but not sufficient to get us back on track. That's why we're looking at this Article 11 more closely than we otherwise would have.
Gotcha. And I've got my eye on the chat as well as the slides now.
Prana,
So can I, sorry, I might have missed a little introduction to that Article 11 thing. So first you were talking about an opportunity, and now this Article 11, totally different subject. You're saying this is a program, and the properties that maybe in any fund or all the funds you're gonna try and move them into this program because it has these benefits. Do I have that right?
That's right.
Okay.
Sorry if I wasn't clear there. Yes.
No, I just need an introduction so I understood how we were switching gears.
Yeah. So we're working with HPD, which is the representative of the New York City government, to do that. Okay. I want to go through by fund here. There's these funds are affected differently, with the signature and the Article 11, and I'll try to be brief, but Prana Current Yield Fund 3 is an older fund. We've distributed most of the capital and profits. It only has 6 Bronx properties left, less than 10 million of unreturned capital. The signature loans, if we modify them based on the latest proposal from Related, it's a 5% increase in NOI. Article 11, if we're successful in getting the buildings in that program, you can see it's a huge increase in NOI, almost 100%. And then the value above the unreturned capital is 156%, combining both of these. So potentially substantial increases in value here. However, given the uncertainty about Article 11, we don't think, and this is true for all our funds, unfortunately, until the latter half of 2025, maybe even into 2026, we don't think we're going to be able to distribute capital to investors. Prana Current Yield Fund 4 doesn't have as much in the way of signature bank loan exposure, so there's really no change due to that. Article 11, a 94% increase in NOI and a 39% increase above the unreturned capital here. We do plan to sell an LA building. The LA market is held up better than New York, so we're hoping in 2025 to sell an LA building and hopefully at a good price. We'll see if there's sufficient proceeds from that to distribute to investors, but that's our plan. Otherwise, assuming we put the New York properties in Article 11, the bulk of the portfolio will try to do distributions on in late 2025-26. Prana Current Yield Fund 5, greater impact from signature loans than Prana Current Yield Fund 4, 25% increase in NOI. Article 11, again, over 100% increase in NOI. and then a 35% increase in the value above the in-return capital if we get both of these in place. Next one. Prana Realty, this is valued on a regular basis, so the numbers are a little bit different here. Talk about the signature loans. As you recall, this is the fund with the largest concentration of signature loans. If we are successful in modifying, it's a 20% increase in NOI. Article 11, an 80% increase in NOI, and then 185% increase in value above the June 30, 2024 value if we are successful in implementing both of these. So that's by fund, and then the one newer fund.
Oh, can I just ask you if you step back there? I noticed a DSC, debt service coverage ratio, I suppose. What is the significance of one of them was below 1?
Yeah,
this one is,
if you go back, Peter, sorry, just go back to the prior one, Chronic Yield Fund 5. This fund had a building with a fire in it, so we lost income. That's coming back online, and the insurance is covering the rental loss there. So that's what happened there. And then all the loans in Chronic Yield Fund 5, save for the signature ones, as of this month, have been modified to to interest only. So this fund is in much better shape than this debt service coverage number indicates.
Okay. And then Prana Realty, which is the fund I'm in, so more interested there.
Yeah, 70% LTV, debt service coverage of 1.17.
Yeah, so does the debt service coverage ratio does that indicate to the bank something about the loan, or what's the consequence of if it raises or lowers?
Well, each bank does its things a little bit differently, but most of the banks now are looking for 1.2, 1.25 debt service coverage. So it's going to come down building by building. Some buildings obviously are going to be well above this 1.17, others are going to be below. And that factors into how Related analyze their signature portfolio, how the properties were throwing off cash, and what's debt service coverage they could use. They were using a 1.2 essentially to back into what the discount should be.
Okay, so the modification and the Article 11 participation is building by building, right?
Right.
So you got to look at each one. Okay, thank you.
And the LTV is indicating that there's 30% leverage, I assume, if 70% LTV.
Yeah, the 30% equity, 70% leverage.
All right. And just for everyone's.
And I apologize on this slide here. The loan amounts in this portfolio are 44 million, not 3.3. 3.3 is actually applies to the next slide. So
44. For those that are listening in here, what I've been reading about the New York market is that when there's a 30% equity position, that the banks and the markets are not terribly worried about that. But when it gets down to 20 or 10% with 80 or 90% leverage, some investors have gotten into trouble, even in Manhattan. So these loan to value numbers, I should say, look reasonable to me. And if we can get the loan down, then we've got a better ratio.
And Prana Housing Preservation Fund is our latest fund. Here it actually has a couple of signature bank loans, so it'll increase the NOI by less than 10%. But also if we can get these buildings in Article 11, it's a big increase in NOI.
Ooh.
And 90% increase in value when combining both of those. This one's in better shape. You can see the LTV and the debt service coverage just because the buildings were purchased relatively recently. We knew going in what the price had to adjust to reflect the loan amounts.
Wow. And if you can increase the rents, the people, really the housing situation is tight for multifamily in New York, is my understanding. Like 2.5% vacancies or 2% vacancies. So it's not like people are going to have many other choices. So I think that the rents going up is not going to drive down the occupancy rate. That's a guess.
And especially in our segment, our average rent in the Bronx is $1,200. In Manhattan, it's $1,300 or $1,400. There's demand many times over for any vacancies we get. So demand is not the issue. Our collections are pretty strong, 97, 98%. It's just the hole that's been created by multi-year rent freezes, combined with insurance is the topic of the moment everywhere. Our insurance costs have gone threefold in the last 4 or 5 years. So our cash flow's gotten squeezed. It isn't a question of demand for the units, or even tenants' ability or willingness to pay. It's all about getting our top line back up, which is what we're going to try to do with the Article 11 and Section 610.
So it sounds to me like even if you could liquidate right now, there's an opportunity for a big increase in value in a very short time period. So
yeah, I really don't think there's a chance to liquidate and pull much money out today. As I mentioned, there's little or no transactions in the market, and we would just be selling to get rid of an obligation, essentially meaning the mortgage. But we think the two elements that we outlined here, there's a chance for material increase in value and to put the buildings on much firmer footing. And our plan is to, as quickly as possible, to get capital back to investors. We know this has been a frustrating ride the last 4 or 5 years, and we want to get distributions restarted where we can. To the extent the yield funds have been out there for a while, we'd like to just sell off buildings and close them down as quickly as we can. But we think we'll be in a better place if we have these Article 11 agreements in place.
yeah, unfortunately on the downside, because of the rising costs combined with the rent controls, the rent controlled market has struggled a bit more than the market rate portion of the market. And there may be fire sales for some time to come as the higher interest rates and the higher costs of operating begin to squeeze out some of the owners. So there could be a headwind in terms of bargains. Is there any possibility that Prana may take advantage of some of these bargains that may show up?
We've been trying to buy. We bought a portfolio in the Bronx in April of 2023. We were finished second in trying to buy a big portfolio in the Bronx. Recently, we had some institutional capital lined up to buy. We think today is a great buying opportunity, but most of the equity in the market doesn't feel that way. So either that
As
means,
always,
that means either we're really out on a limb or we're onto something. We're not sure which, but we think based on what you can purchase these properties for, even without the Article 11, they're throwing off a fair amount of cash, even with the higher mortgage rates. And we think it's a good time to buy. But we thought that 3 months ago, and we could still be in the same position 6-9 months from now. So not clear what the right answer is, but there's the start of it is some local operators in New York and LA are starting to buy, and we'll see if some of the larger players come back in as the market stabilizes, and maybe it's clear who's willing to lend on this type of product.
A couple of articles that I read indicated that activity has been starting to pick up in the last 3 months, let's say, and the beginning of the year wasn't great. So this really is changing almost minute by minute. And there's also some talk of New York City recognizing that they're squeezing out the owners, and that's not good for their housing supply. So I guess they're considering easing up on some of the regulations or revising them, perhaps.
They actually did in April modify in a very small way some of the draconian elements of their 2019 law, specifically upon vacancy. They had a complicated formula that capped the amount you got credit for renovating a unit at $15,000. As a result, a lot of units in the market were staying vacant because if it cost an owner 40-50,000 to renovate it, they weren't going to be able to recapture that in higher rent. So they just let it sit vacant, which is, in my mind, a travesty in a market where housing is extremely tight. So there's thousands of units, rent stabilized units that are sitting vacant because it's not economic to redo them. But the politicians did change the rule a little bit and doubled the credit you get from 15,000 to 30,000. On the margin, that might get a few more units back into circulation, but really isn't enough. They need to do more than that.
Hmm.
So yes, Peter, they have recognized the problems that they've created, but there's a lot of people that either don't believe it or don't care.
Sure. Well, I'm watching the trend. At least there's the beginnings of conversation, and that may be indicative of future trends.
Could you talk about for a minute the timeline of this Article 11? I mean, I'm seeing the fact that it increases the value, doubling and tripling the value of the properties. So that's pretty important. Could you just talk about the timeline of when we'll know whether or not?
That's very important, and I'm glad you asked that question. We wish it could be done tomorrow. We're actually in the throes of 15 buildings with HPD right now, and that's the start of it. And we're hoping to add buildings to the pool, if you will, on a regular basis. We have sent through all kinds of information to them. Our first big meeting is next week. Realistically, the constraint is not on our end, even though there's a lot of information required about the operations of the building, how they're capitalized, ownership, all that kind of stuff. It's a capacity issue at HPD. So realistically, we think it could be another year before our buildings are in an Article 11 program, maybe even longer, depending on what the capacity is. So what we're trying to do is create a process with HPD where they know that we can get them the information accurately and timely. And hopefully they'll choose us over other people to do business with who aren't on top of things or maybe are more difficult to deal with.
Right. Try to increase that relationship.
Yeah, that's
And be a reliable. Yeah. Yeah. Can you tell me again what HPD stands for?
Housing Preservation and Development.
Thanks.
Okay, and did we cover Jed's question of about 20 minutes ago on stabilized rents? He asked if there was any relief on, and we kind of touched on.
I think we did, but I'm happy to answer any more questions on that.
Jed, do you have any follow-on questions to your original? All right, looked like his answer was no. I had to lip read there, but it's okay.
Any other questions on what we put together here? I'm happy to answer whatever you got.
I have a few thoughts and questions that I jotted down. One of the articles I read said that the dollar amounts of transactions, at least in Manhattan, were higher this year, although the quantity of deals, the number of deals, was down. So, as you indicated, maybe there's a small pickup in people getting back into the market and wanting to buy. Just the first inklings, which of course is the time that you really want to be in there, if you can.
Yeah, I'm not sure, Peter, what whether that included retail and office buildings or just because we tend to look at things just in our segment, so we can figure out buildings that are rent regulated, rent stabilized that transact. So we have pretty good data going back 20, 25 years. And Manhattan last year, I think the total dollar volume in our segment was under 400 million. And at the peak in 2017, 2018, it was 2 billion. So just a great reduction. The same in the Bronx, not quite as stark, but similar. I think other things in Manhattan are picking up. Manhattan, in particular in New York and parts of Brooklyn, are incredibly vibrant, and I think people are doing deals in those. I see that even New York City, some of the older office buildings are trading. So everything has a price.
Sure. I'm looking at this article. Now, I don't have access to ongoing high-level sort of industry information. So I'm probably misinterpreting what I'm seeing, but it talked about multifamily transactions in particular. Sales are up 23% by dollar volume and then it's under a heading of Manhattan, but doesn't mean that this paragraph is.
Yeah, well, that could also include the market rate.
Oh yeah, I'm sure it does actually. Yeah. So unfortunately for everyone's information, the decline in interest rates, which would continue to be a positive for real estate, seems to be paused. We'll find out in November if the Fed's going to go ahead and make the next move. But there's been strong job reports, and inflation isn't quite down to where they want it. So I don't know if they're going to pause, but it may slow down. And we don't see a recession on the horizon yet, if it's coming. But it could be a while before rates continue their decline. But if they do, that will be a plus. And we talked a little bit about the banking situation there and Related Bank. I haven't, or Related was an entity that you referred to. I've not heard of, but how is the banking situation there?
Well, all the traditional lenders in our space in New York, Signature being the obvious one, but New York Community Bank, you may have read about, also went through some things. Dime Savings, NEC One, EPAC, are all trying to hold on. You know, they're getting scrutiny by the regulators, and they're really not putting new capital out. So, and then the larger banks really don't want to be in this segment, so they're not a factor. You know, the B of A's and the like. So again, as I mentioned at the outset, the transition in our space, and especially if we have an Article 11 regulatory agreement, there's various government loan programs through HUD, Fannie and Freddie, where you get a 50 or 75 basis point discount on the interest rate, better loan to value, lower debt service coverage, longer amortization, all the things that make for a more robust loan and loan proceeds. So our goal is to get there so we can access that capital and return capital to our investors.
We've covered leverage. And the guarantee it depends on the partnership or the investment vehicle, but there is a promise to repay investors' principal and accumulated simple interest up to 6 or 8%. I'm not sure if some of them fell into 4%, but to me, that's a great comfort structurally. Do you have any comments or anything to add?
Yeah, no, and Prana Realty, for example, we have a lot of catching up to do before we get compensated. So, and that's true pretty much of all the funds here. You know, our priority is to get your capital back and then a return on top of that. But, you know, you have to get at least an 8%, your capital back and an 8% return before we'd share in anything. So, we're a long ways from that in each of these funds. We think we'll get closer if we can include some of these initiatives, but the investors are in the best position as far as the priority of getting capital back.
And Prana does have a management arm that gets paid, correct?
Well, it depends on the fund. So
Okay.
Prana Realty and Prana Current Yield Fund 3 have no ongoing portfolio management fees. Prana Current Yield Fund 4, Prana Current Yield Fund 5, and Prana Housing Preservation Fund all have ongoing management fees.
And can you speak to how high the management fees are and what other things may be included in operating expenses?
Yeah, if they're there, the management fees range between 1 and 1.5% of investor capital. And there is, to the extent we use Prana resources to manage the buildings, there's a reimbursement mechanism for that.
That sounds pretty typical in terms of percentage charge, but I would think it's on the entire value. You're saying it's on.
It's just on the unreturned investor equity, not on the value of the portfolio.
It sounds like it may actually be pretty low then.
Yeah, well, we've always been pretty back end oriented, so that's life is more interesting when you're doing well for your investors and you get to share in some of the upside. Here we're trying to dig out from a difficult situation, which we intend to do.
I was just working with a family with quite a bit of real estate, and the 2008, 2009 crisis hit them really hard. And some of that's still rippling out today. And it's been, 15 years later. Jet, did you have any follow-on questions? Because I have all of your questions listed here as they came in, but it seems like we've covered most of them.
Peter?
Yeah.
I asked a question. I don't think you noticed it in chat.
Oh, okay.
With all of these different funds, I'm not sure which two are the funds that I'm engaged in. And of these two, I was wondering if there's prospective liquidation dates. And then I have a question about the distribution. Why would you distribute if there's still a good opportunity to put the funds back into more capital, equity?
Good question. Anything that's a closed-end fund, so that would be the yield funds and Prana Housing Preservation Fund, a little bit of an exception because it still has some capital to invest. We want to buy some more buildings there, but once we buy buildings in the yield funds, we can't sell a property and buy another one. We're obligated to return the proceeds of that sale to first the investors and then however the splits are above that. So we can't buy additional buildings. In Prana Realty, it's an open-end fund, and when the markets were functioning in a better way, we'd sell a building and then reinvest the proceeds in another one. So that was the idea, was to over time build up the value of the portfolio when we sold the building. So some would go to the ongoing dividends from Prana Realty as a private REIT, and some would be deployed into buying additional assets. But right now, given the cash constraints, that fund doesn't have the wherewithal to buy additional properties. Our priority is to resume distributions in that fund, and then to the extent that people want out, to redeem their units to get them out. We're not going to be using excess proceeds to buy additional buildings in that partnership.
And Jerry, the answer to your question about which partnerships you own, one of them is Prana Realty Company, which Neil was just talking about. So that would probably be in line for distributions fairly soon. The Prana Housing Preservation Fund is the other one that you're in. So
yeah, the Prana Housing Preservation Fund's already had 2 sets of distributions. We expect to start distributions there in the first quarter of next year. Again, we're trying to buy a couple more buildings in that. Prana Realty, Peter, just to set expectations, yes, I would like to start distributions as soon as we can, but realistically, until we're clear of the signature bank negotiations and have a pretty good handle on Article 11, we're going to preserve our cash so we can negotiate from a strong position with either related in the FDIC or with HPD.
And I thought of that as I said it, that the way I meant early distributions is in relation to the longer haul, so it still could be a couple of years out, a year or two out, I would think.
Yeah.
So, Jerry, does that answer your questions?
I didn't get the prospective dates of liquidation.
Late 2025 would be the So the third or fourth quarter of 2025, maybe into 2026.
Both of them.
Yeah.
Okay.
Prana Housing Preservation Fund actually would go longer because that fund, started in 2022.
Yeah.
5-year life, it's probably 2027, 28, 29 before we start
Okay.
liquidating assets.
All right. Thank you.
And Jed, how about you? Any follow-ups?
Yeah, can you hear me okay now?
Yes, sir.
Okay, what happens if interest rates stay at 6% for the next 2 years?
It's all that much more incumbent upon us to get these, especially the Article 11 in place, because even at a 6% interest rate, the cash flow will be much greater out of the partnership. We can refinance, pull capital out, provide it to investors.
One other follow-up question, does the Article 11 incorporation restrict your sale of the properties?
You have to sell it to somebody that's approved by the HPD, the New York City's housing representative. And just to give you an idea, we've bought multiple portfolios that are like this. We have to go through an approval process. It takes anywhere from 3 to 6 months, but it is doable. And in fact, we think buildings with Article 11 in place are going to be more valuable, more in demand than the standard rent stabilized buildings.
So it improves your value, but also the next buyer's value.
That's right, because they're more certain of the cash flows.
That's good news. It looked to me like the occupancy rate across all of New York City was somewhere between 1.5% and 2.25% or something like that. So occupancy is strong. One article I read said there's not much construction going on. Another one said that it's picking up. So I don't know if that's from a low level, but how about future development crowding in to the space?
Certainly in our segment, it's not going to be much of a factor. New York not only put caps on the amounts we could charge the rent stabilized, but they let lapse for 12 or 18 months a tax credit, a tax reduction provision that really got a lot of apartment development started in New York, and they let that lapse for 12 or 18 months. So new construction in the affordable space is pretty limited. Even in the market rate space, it's there's not that much of it in New York.
Interesting. That's what I like, is to hear the anecdotal on the street, on the ground, in the buildings kind of conversations. Yeah, so I think I covered my questions and comments. Any other questions?
Yeah, just real quick, when we talked about the Article 11 to 18 months, is that to get the first building in, or is that to get, hopefully all buildings in?
Hopefully all buildings in.
I see. So some of them should enter the program earlier because you're submitting things now, and that's, you think, a couple of month process per building?
Probably 3 months maybe. And then, but again, it's all capacity HPD. So
Right.
We're trying to make their life as easy as possible. Let the project manager that we're working with be a hero, because he or she can get more units in the program. So that's what our goal is.
Okay, thanks.
Well, to me, this has been really enlightening and encouraging too, both in the respect that I thought it might be another 3 or 4 years, 5 years before the market returned to a normal enough operation that there'd be distributions from buildings. I'm very encouraged by the changes in the opportunities that you see for the loans.
Yep.
And in converting to the Section 8 housing. It's hard to believe that those prices are higher than what you've been charging, but that shows what happens when people stay in buildings for a long time, I suppose.
That's right. And there is a big embedded tendency there. So, well, listen, I really appreciate you taking the time to talk to me, and hopefully I've passed along some new information, additional information that provides more clarity on your investment. I differ with Peter a little bit. We want these changes to happen now. And then, the markets had this long slide, triggered in part by the rising interest rates, in part by, the changes in the rent regulations. But we want a turnaround, and we're doing our best to make that as quickly as possible. But we're working with the hand we're dealt, so to speak, and hopefully we'll have more good news to report to you over the next quarter or two.
That's great. You can disagree with me anytime, but I think I'm really on the same page on that one. But I welcome input, just because we're always on the search to get closer to the truth of situations, and sometimes we have to use a little approximation and not guesswork. But that was my opinion that now has been altered somewhat since the call. So again, thank you, Neil, and thank you, everybody. This next 12 months looks like it may be profitable compared to where we are now. So I'm encouraged.
Okay,
Yeah, thank you very much, guys.
thank you.
Okay, and if they have questions, Neil, reach out to you or to me.
Yeah,
Right?
absolutely.
Okay, great. Thanks again.
Thank you.
Have a great rest of the week.